see the numbers are picking up here. So we'll just get started. Hello and welcome everybody. My name is Anne Charlotte. I'm the Senior Wealth Advisor here at Sanlam Private Wealth in Mauritius, and I'm going to be hosting the webinar today. We are very pleased to have you join us again for another part of our webinar series that we've had throughout the week. And today we'll be chatting to Peter and Hannah from the Global High Quality team. So thank you, Peter. Thanks, Hannah. Always lovely to see you. I'm sure all of you guys joining us have had the opportunity to hear from Peter and Hannah before, but just as a quick introduction, Peter is the head of global equities and lead fund manager of the award-winning Sanlam Global High Quality Fund. Based in London, Peter and his team manages assets in excess of $1.2 billion. And Peter will be joined today in the presentation by Hannah, who's a core member of the Global High Quality team, and she's the dedicated go-to person for any question or queries that we have surrounding the strategy and the execution of the investment strategy of the fund. I just want to say thank you guys for joining us. We're very much looking forward to the presentation today. So I'll let you start. Peter, you can share your screen. So some housekeeping. We'll get the questions that you can send through by the chat throughout the presentation, and we'll go for some question time after the presentation. So thank you, and over to you, Peter.
Thank you very much, Anne. So hopefully everybody can see the screen. It's just going to throw it up a bit larger. Thank you very much for your time today. I'm going to try and stick to 35 minutes. Just for the sake of how we would be doing this presentation, I will cover our process very briefly again in case there are anyone in the audience that haven't heard the process before. I think process and highlighting how we invest on behalf of our $2.2 billion of assets is very important to me at this stage of the investment cycle, where there's a lot of trends, there's a lot of reversal in trends, awful lot of noise, awful lot of interference from global banks. And I think it's very, very important to illustrate to your investors how you generate returns, and in fact, I will do that going forward as well. So there's just a snapshot of our assets. We have 1.3 billion in assets in institutional funds, and also in high net worth assets, $800 million. Last year, we were fortunate to win a couple of awards again. You're probably not going to actually see Hannah in person today, but she is sitting next to me. As Anne says, a product specialist that will help you with any queries, but she's also won an award 2 years ago for Young Investment Woman of the Year. So we are very proud that we are an institutional asset management team, but we roll out our services to our high net worth clients as well. And to highlight again our process of how we operate as a team, we are all generalists on the investment side. We are supported by 2 product specialists in Nick Bell, our head of global clients, and Hannah, our global equity investment analyst. They work very, very closely with the investment team. They know exactly why we own a company. If we do own one, they also know the sort of names that we will obviously avoid, as you would expect from a high quality team. And this year, if you look at our performances, you'll see why I'm a big proponent for being a generalist. We don't believe in sector specialists. If you look at, for instance, some of our top performers again this year, Google is a media company covered by myself. William covers Anthem. That's been a big mover for us this year. I cover Samsung on the information technology side. That's been a great winner for us. And Fiserv is a new position I've brought into the portfolio as an analyst. But we've also, so far this year, have a great bounce from a name like Sabre, which is covered by Shiraz. And Tencent's been a big winner for us over 5 years, covered by Louis. So we like to have our knowledge spread within the team. We act, therefore, also as devil advocate for each name in the portfolio amongst ourselves. and it keeps us all engaged in different sectors with different drivers, but ultimately with one goal: to invest in great businesses, keep them for the long term, but don't overpay in order to get that outperformance versus the market over time. So here is what we do: 120 names that we cover in detail. We are active managers. We believe that watch list is big enough for us to make the statement that there's only so many great businesses in the world. I'm a big believer that the vast majority of business are inferior, the way we look at it, measured by measurable things like return on equity, free cash flow generation, capital intensity, balance sheet strength, to name but a few. And we're also big believers that we should have a high conviction portfolio in order to generate alpha. Now, what's happened, and I will touch upon this just because so much has been talked about this, but the last year, what's happened in the market and what's been working in the market over the last few years has become more and more narrow. And what do we mean by that? So we have quite a few large cap, mostly US technology / growth type names that dominate the universe and actually made the index itself from 10 years ago, where it was quite a diversified index. This index has become more and more concentrated. And we find ourselves in a position where, as active managers, we can add a lot of value if we can now stray away from that index, if it makes sense, and where it makes sense, and add value by being focused only on 25 to 35 of our best names. So here are the criteria that we're looking for in our companies. Nothing has changed in the 13 years that I've been managing this strategy. Nothing has changed in how we look at the world. We are going to show you that our strategy has reached new highs. We've had a very strong March. We're very excited by the fact that this outperformance in March in particular came from companies that are very high quality businesses, but they are not the sort of businesses that you would have seen in the index, and that's been driving the market over the last 12 months. So we're very happy, especially with some of the new names we've added, that's starting to add value to the portfolio. And we are going to keep compounding at a very acceptable rate, hopefully over time, if we look at the quality of the businesses we own today, as well as where the valuations are trading, not just on an absolute basis, but certainly a lot more attractive than large parts of the market where we think valuations are very stretched. So just to summarize, a high conviction portfolio, our biggest position today is 4.8%. So the size is between 3 and 6% typically. We do work on a risk reward basis. Very important on our sell discipline. We only sell when there's a change in the business fundamentals. That does happen very, very sporadically. We obviously, as a high quality strategy, you wouldn't expect us to get the business model wrong, but it does happen, and we'd be ruthless to exit those positions. But because we are valuation obsessed to an extent, we obviously look at when a company trades above fair value. We don't just methodically sell that position, because of course, if you own a great business and it's temporarily overvalued, we find it difficult to replace that position. But I think a good example would be Microsoft, where it's been trading consistently a little bit above fair value now for maybe 2-3 years, but we were very reluctant to sell out of that position because our stocks just compound their intrinsic value over time, and it's been the right decision just to hold on to that name, even though it hasn't been a top 10 for us for maybe 2 or 3 years now. It's been a core position for us for over a decade. So looking at performance in nominal terms, very strong. Close to 100% return over the 7 years that we've had. The fund launched back in February 14. For the eagle-eyed amongst you, you will notice that both in 2020 and so far this year, we are lagging the market. It's been an exceptional volatile environment, we believe that we've changed the portfolio significantly over the last year and used the volatility in the market to actually improve the quality of the portfolio. And different set of factors that are actually driving the market this year so far. I mean, we have seen, and I will discuss this in our presentation, we've seen a massive rally from early November in financials, energy, and industrials, and we've seen those businesses that have performed very strongly post the market crash in March last year, mostly the technology companies. A lot of them have actually been going sideways or have been underperforming now for 4 or 5 months. And I will illustrate to you how we've used this volatility to get the best out of the performance of the market for our investors. What I would say this year, it's very encouraging that, you know, this whole debate about, are you a growth investor? Are you a value investor? You know, we are unashamedly value investors, but we don't describe value as a statistically cheap phenomenon. We buy businesses that are trading below intrinsic value. Sometimes they're classified as growth businesses, sometimes they're classified as value businesses. We will illustrate to you how a mix of businesses that are both growth and value constituents have performed for us, but they're performing because they traded below intrinsic value for us. So the long-term benefit of the strategies is clear to see here. You can see now that we've actually included, and Hannah's been on the ball so much, we've already got our NAV, our net asset value in for close of business yesterday. The compounding effect of a high quality strategy where you pay attention to valuation is clear to see. Over time, the compounding effect of that is illustrated in the long-term performance. 60% ahead of the market on a compound basis, quite significant over 10 years as well. And you know, even though there is the noticeable lag over 1, 3, and 5 years, the reality is that a very, very narrow market of only a few regions in particular working really well, mostly the US, and within that, typically your high growth companies with very high valuations. We're very happy over 5 years that we only about 1.5% annualized behind the index, but from a position currently where we are very happy about the valuation of the portfolio and the quality of the companies we own. And we are hopeful that the ongoing compounding effect of our strategy over time would, as it's always been the case over the long term for us, would open up the jaws, so to speak, versus the index if we stick to our philosophy ruthlessly. So let me just talk a little bit about the last 5 to 6 months and what's happened in the market, because I think this is the question that most investors now have. And what you see here is I just want to focus on that bottom graph first. If you look at that green line, it shows you the yield on the 10-year US Treasury. Why is that important? Because if we use discounted cash flow analysis, which is our main tool to determine intrinsic value, then of course it's important the risk-free rate that you use to discount that exact cash flows you're trying to calculate. So from our perspective, we've always used a 3.5% risk-free rate. And when the 10-year yield went down all the way to about 58 basis points back in September, we've heard things that I've heard before in the 20 years that I've been investing in high quality companies, that it's different this time. It's different because yields are permanently, is going to stay low permanently. Bonds are expensive, therefore equity should also be expensive. Those sort of arguments, which, you know, as an investor focused on quality and not wanting to overpay for assets, I don't think that's really being truthful to how a long-term investor should look at the world. So we were very reluctant by the end of September to overpay for assets because of the narrowness of the market. And that narrowness of the market's illustrated in the top bit, where you can see this very big outperformance of growth versus value. And since then, the market's changed quite a bit. So right up to the end of September. For those of you who've listened to me before, I mean, we were active sellers in names like Facebook and Google, based on valuations. Subsequently, we have added again to a name like Facebook in the $250 level, but we were seeing opportunities in companies like Anthem, like AbbVie, like Samsung, which have performed exceptionally well for us from this period. And whilst we were selling some of our winners that were working very well at that stage and buying companies that were out of favor, but certainly in our minds were very high quality businesses, that's worked out really well for us. And for some of our competitors, and I'm always careful to talk about, who are competitors. My main competitor is always Mr. Market itself, the index. But if you didn't pay attention to valuations and you just were stuck in a very concentrated growth type portfolio with large cap US and Asian technology businesses, you probably would have struggled significantly from the September period. We've also slightly underperformed, but we've certainly had a very, very good investment experience versus your typical high quality momentum strategy. And that's what we're trying to avoid over time. And here's a good example for you of why we think it's important to pay attention to valuation. Samsung was a great performer for us last year. I think it went up about 60%. And based on some valuation measures, you can see their price to book, price to sales ratio. Those are not two that we use, but they neatly illustrate just the massive re-rating that those stocks have experienced over that period from sort of February, March 21, and all the way up to the end of the year. Now, we sold Samsung back in January. We think it is a great business, and we've owned it twice over the last decade, but we're just sitting back and digesting the short-term overvaluation in that name and looking for an entry point to get back in should the market be kind enough to restore fair value back to a level closer to intrinsic value. But it shows you how quickly the market can also move. You can see that revaluation in the stock happened in the space of 6 months. It's been a great performer for us. As I said, we had been invested for over 3 years in Samsung. The return was close to 100%, but literally 70 or 80% of that return came from the last few months in that period from May 20 up until January 21. And now we are happy to have replaced Samsung with some other companies that have been doing really well for us. So when you look at year-to-date returns, it's also very different to 2020. You've got energy and financials outperforming. We calculate that, we typically don't own energy and financial stocks. We haven't owned them for 13 years in our strategy. And we also notice that information technology, unlike last year, it's actually, with the exception of consumer staples and healthcare, it's actually quite weak versus the market. The overall market's up about 5%. But what we did find is that even though in the words of Hannah, as the investment analyst, the allocation effect has been bad. And what does that mean? Not owning energy and financial stock cost us about 400 or 500 basis points this year, but our stock selection's been very, very good, especially within information technology and industrials, where we own General Dynamics as our only industrial exposure. And that is what we'd like to see, is to see our selection come through in terms of our stock picking abilities. And I will take you through why, the likes of Apple and Amazon is not a drag on our portfolio anymore, because we don't own them. We think they're great businesses, and we'd like to own them in due course. But we've also got our stock selection right in sectors in terms of huge outperformance for us in some of these different sectors. And why do we own so much healthcare? If you look at the orange line, that represents the discount of the healthcare sector in the US versus the wider market. The wider market is that black line. You can see, if you cast your eyes on the black line and go to the left, you can see their forward price earnings ratios of 22, For the S&P, is historically quite expensive. There are other ways that you can look at it. Profits as a percentage of gross domestic product. You can look at price to sales, various measures, CAPE, the so-called CAPE valuation measures, or the sort of annualized average 10-year earnings measure. All of those things would indicate the S&P is quite expensive, whereas healthcare at face value is quite attractively priced. And we've had, as I said, some great successes over the last 6 months from new positions like AbbVie and Anthem, which I will talk about in the next 10 minutes or so. And the same is true for consumer staples as well. When you look at the discount that consumer staples are trading at against the market, typically it used to be at a premium during the period where bond yields were dropping, but as bond yields picked up, we saw a vicious derating in that sector. Now we've positioned ourselves in advance of this move, not because we saw bond yields go up, but you might recall that back in November, when the vaccine news came out on that infamous day, the 9th of November, with I think it was the Pfizer news first, about the efficacy and how successful it's been. We saw a huge spike in names like Diageo and Heineken, and we sold those positions. But we held on to our names like Bookings, Intercontinental Hotels, Sabre Corporation, and they've had significant moves for us over time. So we have lately been adding again to our Unilevers and our Reckitt's. As an example, we also still have a fairly large tobacco exposure, which have really done well for us over the last 4 or 5 months from very depressed low valuations. So consumer staples remains an interesting area that we're watching, but at this stage we still have a lot more exposure to healthcare, and at the margin we've been reducing consumer staples over the full sort of 1 year period. So here's our sector positioning. Very briefly, you can see no financials and energy exposure. Even though we're 90 basis points behind the index this year, very happy that when you look at the significant moves from financials in particular and energy, so respectively 42% for financials, energy, 63% move from that September low. We're very happy that the performance of the fund is not far behind the index in the face of some very, very big moves from sectors where we don't have any exposure. Just on the attribution, roughly, very encouraging for me that a name like General Dynamics, which we've owned for over 3 years, they own defense assets. They also own Gulfstream as a division. It's been our top performer. And Anthem is a healthcare insurer we bought back in August. We thought it's very attractively priced. And then you have some long-term positions like Alphabet also performing well for us. Last year, Sabre was a significant drag on the portfolio, and it's come through for us today as the second largest travel software company in the world. They've certainly bore the brunt of bad news flow over the last year, but they are still fundamentally challenged. But if the world normalizes, which we expect by the middle of 2023 for the travel industry, then this position has some upside still left, and we're happy that it's bounced significantly. On the downside, it's fair to say that companies that are seen as defensive revenue streams are having a bit of a tougher time, like Fresenius and Novartis, where the market has effectively taken a short-term, a dim view on these businesses in the face of higher bond yields, but where we believe that 6 to 7% free cash flow yield that we get in those businesses, should the market have a setback, which we don't know if it will happen, but those defensive businesses can be very attractive for us. So here's our fund activity summary. Sold Samsung, as I said. We invested in Fiserv. There's a graph from Hannah prepared for me in terms of why we believe Fiserv is very attractively priced versus its peers in the payment sector. They are very well integrated business with the banks that they serve as customers. We also have Akamai, which is in internet security services, attractively priced business. And we've been using weakness in companies like SAP, Facebook, and Anthem this year to add it what was quite significant positions. Now, I think Anthem finished the month up close to 20%, and we were quite active buyers back in February and made it at that stage a top 3 position. Because of the strong performance, it's grown to our biggest position. And we've been selling finally some of our names in the travel sector where we've had significant bounces. Just to put it in perspective, Intercontinental touched £22 a year ago. Today it's trading at £51. That's 140% odd move, and probably more in US dollars. It just shows you how panicky the market actually became. We added to this position at £34 at one stage, and now we're just trimming it above 50. So here's our top positions, very well diversified between sectors. Alibaba, I might spend some time on that, although I probably won't have too much time today because I want to leave some time for questions and answers. But we are positioned in a selection of stock-specific high-quality companies. To give you an example, we have 2 of the very large Swiss cash-generative pharmaceutical businesses there in Novartis and Roche. But we also have, in the short term, what's turning out to be quite a controversial name like Alibaba. We think there's massive tailwinds behind this business in the e-commerce side, also in the cloud business, and eventually in the advertising business is an option for them long term. A lot of negative news flow, but we are seeing signs, hopefully, that the negative news flows will stabilize in due course, and we believe at low valuations relative to its own trading history. We've been building up that position in Alibaba from August last year. So just some case studies. Anthem, we've highlighted there where we started building the position. Anthem's the second largest healthcare insurance business after United Healthcare in the US. And of course, what you'd like to see is that price earnings ratio move up. That's a function of the market taking the stock from about 260 in August all the way up to where it is today, 360. Our intrinsic value is $410. Anthem has historically significantly outperformed the market because of its very strong economic moat. And we are going to hold on to this business unless it approaches a level significantly above intrinsic value. We think our entry point for long-term investors has been quite good. In terms of Fiserv, that orange graph shows you the discount that Fiserv trades at against some of the other assets that we are looking at to invest. Paychecks, Intuit, Visa, MasterCard, PayPal, they're all on our watch list of 120 names that we'd like to invest in. They are quite expensive. We have a position in Visa. We've had positions in PayPal. We are always doing more work on these companies. But we believe Fiserv offered us a unique opportunity in February to invest in this name. They have 3 divisions. I don't have time to go through all the details today, but they do have through the merger that happened about 18 months, 2 years ago with First Data Corporation. They have a very well diversified business now. They have very, very good free cash flow dynamics. And we believe the payments assets that they have within their industry makeup is undervalued compared to some of the players that are seen as a stronger fundamental position in the industry. And we are glad that we are off to a decent start with this name. General Dynamics, it is a little bit of a busy graph. I just want you to focus on the left-hand side. This was taken from Bernstein, and you can see there some of the quality factors that they use when they constructed this graph. They said that if you look at things like return on equity, earning stability, sales growth, operating margins, they think the defense industry is very well positioned. So it is interesting how it's been a big and solid performer for us. And it's the same on the right-hand side in terms of valuation. Very attractive free cash flow yield. You can see Staples Healthcare Services, which is Anthem, and defense rate quite high in terms of free cash flow yield. We think in a low return environment, it's important to have good free cash flow yields. They might not be growing as fast in the case of General Dynamics as a Google or Facebook. But for us, it's the combination of having all these assets trading below intrinsic value, which attracts us to our own portfolio, of course. So very briefly, I think I've been going now for 35, 32 odd minutes. Just my thoughts on equity market valuations. I do believe that markets are expensive at a headline level. There are a lot of big, large cap US stocks that are driving the overall market environment, and they are expensive. We believe, however, our portfolio is attractively priced at 6% free cash flow yield for next year. And very importantly, if you look at our top 10, I did an analysis the other day of valuations. I took the top 10 and looked back over 5 years. And it's basically a flat line in terms of valuations, even though, of course, we're up 74% in US dollars over 5 years. Now, the reason those valuations haven't moved is because that growth and those returns that are being generated in the portfolio is because of growth in free cash flow, not because our stocks are getting more expensive. And because we are rotating the portfolio away from overvalued stocks into stocks that are attractively priced, we believe we are well positioned going forward. Certainly, that's third last point, staples and healthcare have been a drag on our portfolio, but we also believe a lot of negativity has been priced into those higher bond yield sensitive sectors, and we think they can behave better going forward. Then on the emerging market side, on a look-through basis, we still have 30% exposure to that area of the world. And we're getting that exposure through a combination of both technology stocks, consumer staple names, as well as consumer discretionary companies like Intercontinental Hotels Group, where China remains a big driver of their overall profitability of the next decade. Just looking at those names that we've highlighted, we did trim the Intercontinental recently, as I said, and we've been buying into SAP, which has clearly lagged some of our other positions like Microsoft and Oracle over the last few years. So just to conclude on today's assessment, our strategies remained unchanged over 13 years. The last year has been tough. I've been through periods like this before in my life. The last month, the last 3 to 4 to 5 months, I'm starting to feel a lot better. I think the world has become a little bit more healthy in terms of moving away from very large cap, momentum driven, valuation agnostic strategies and more towards those businesses that really still offer value on an intrinsic basis. And this volatility has allowed us to disinvest from names, as I said, like Heineken, Diageo, Samsung, and we've been buying new positions over the last year, like Fiserv, like AbbVie, and like SAP, where we are intrigued by the long-term opportunity for these businesses to compound wealth for our investors without having to overpay. So it's very important for us to avoid permanent loss of capital. I think if you invest in a great business, your chance of avoiding a permanent loss of capital is minimized. It's not always, can't say hand on heart that we think there's no chance of capital loss, but certainly buying a great business is a good starting point. So what makes the portfolio a high quality portfolio is that 27% return on equity, and of course free cash flow yield, which in our view will continue to grow at about 7 to 9% per annum. So with that, I think I'm sticking to my 35 minutes to leave some questions, some questions for you that hopefully I can have answers to. And thank you very much for your time today. If there are no questions, I'm not sure if there will be, then I just want to wish all of you a very happy Easter holiday.
Thank you, Peter. We do. Thank you very much. It was a very good presentation from you today. Just to open up the floor now to some questions, we will unmute the webinar so that if the audience has a question, please raise your little hand down the bottom, and please, you can ask your questions directly to Peter. And perhaps what I'll do is I'll start with some questions, Peter. You briefly touched on it, but do you think we are nearing a bubble with regards to growth stocks?
Thank you for the question, Anne. So I think it's quite a blunt statement. I think we've got to look at the detail, obviously, around the index and where some of these companies are trading at. So when I joined Sanlam 8 years ago, a company like Microsoft was trading at close to 8-9% free cash flow yield. Today, that's 3.5%. Clearly, Microsoft is not the opportunity it was back in 2012, but the reality is also that going forward, we would just lower our return expectation for that name going forward. We're not going to compound at 20 or 25% per annum like we did over 8 years, but it can still compound at an acceptable rate of 7 to 9%, which I think will beat the market over time. I think in terms of clear overvaluation, to me, if you look at the areas in the short term that's actually hurt us, you must be very careful that people would like to look at a headline number and perhaps conclude that some of these software businesses are overvalued, whether it's companies we don't own like Adobe, Intuit, S&P Global, Moody's Corporations. Those are names that we've either owned before or would like to own. They are expensive at a headline level, but as quality investors, we always find that if you pay a fair value for companies, they tend to work out well in the long term. What we don't want to do, apologies, is we don't want to get sucked into areas of the market that's now very hot. I think semiconductors would be an example. Great businesses out there like Taiwan Semiconductor, but the market's pricing in a lot of good news around that name over the next 3 years. Electric vehicles, they might have a great future long term. We struggle to get our heads around the valuations. Financials have had a large bounce. There's no doubt that there was deep value in energy and financials over the last 5 or 6 months, but we typically don't invest in those sectors. So I think that sort of relative pain's out the way. We think that valuations will stabilize for high growth, high quality businesses if yields don't push on all the way through 2% for your 10-year treasury bond. But we try to compensate for that, as I said, by using a 3.5% risk-free rate when we determine our required return. So we happy that if we analyze businesses that we don't own yet, like an S&P Global or Intercontinental Exchange, when the time's right, we can invest in those businesses knowing that a 7 to 9% return, should that materialize, will actually over time beat the market significantly. I think most investors are way too optimistic about what a general market return can be. You can see in that long-term return over 13 years, I think it will probably be, Hannah will have the exact number, but it's probably 8.5 to 8.7% compound. And compared to 6% for the market, that adds up to a significant performance over time. So we are very happy to buy a business at 5% free cash flow yield, 20 times earnings, if it can compound those earnings over time. Our portfolio, we certainly confident that we are not owning any stock that's in a bubble territory. It doesn't mean that I'm not worried about Visa in the very short term, because valuations look a little bit stretched. The market is discounting quite a big recovery in their main verticals over the next 18 months, but we are also reluctant to sell out of them because we compensate for that by also owning some other assets like Anthem, which was not only statistically cheap, but is also performing very well for us. So it's all about getting the balance right in the long term.
Thanks, Peter. Just another question that came through, and you touched on that briefly in one of the slides earlier. What is the view on the energy sector?
Yeah, so I think it's, if you look at Biden's comments yesterday about how he's going to spend, wants to spend a lot of money in the electric vehicle side. So here's the challenge. On the one side, you have, the electric vehicle industry looks to us like the type of story that we don't want to own. And why? Because we are disciples of the capital cycle. And what do I mean by that? The more capital that's thrown at an industry, the more likelihood that that industry returns over time will also diminish, because there's a lot of capital chasing the opportunity. Now, energy is almost bipolar to what's happening in electric vehicles. I think those big integrated oil businesses, and they're really the ones that's going to drive the index, they are starved of capital, and they're trying to evolve and move away from fossil fuels into clean energy. Now, if I look at clean energy assets, they look, and I mean, it's just my opinion, that they look horribly overvalued to me mostly. Maybe there are some individual opportunities there, but on the one hand, the integrated oil businesses are challenged with their core business, but they also have to go and buy assets to please the regulators and all the other stakeholders in the industry. And they're going to end up probably overpaying for clean energy. So, when I compare those energy names to a business like Fiserv and Anthem, where we're getting 6 to 7% free cash flow yield with very low capital intensity, very strong market positioning, a clear path to growth in a part of the industry where I know that we will earn a bigger slice of the economic pie over time. That to us just makes a lot more sense than trying to call the bottom in energy stocks. Now, we went into the last quarter of last year, perhaps not on public record, but in the team, we accepted the fact that from a statistical point of view, financials and energy will probably have a big bounce. That bounce has happened. It's cost us 800 basis points on relative terms, but we've made up most of that through stock selection, and we accept that that is just the way it's going to be. If I look at the strategy over 10 years, not owning those sectors like energy has been a massive tailwind, so I can't have my cake and eat it. But I think from here, it's going to be very difficult for energy to match the relative outperformance that we've seen over the last 5 months. And maybe some of the concerns that the market have about debt levels, capital intensity, the long-term outlook for growth in the oil industry itself will come back to worry the market again, and we will be much more busy at trying to figure out when is a good time to buy some of those companies we don't own yet in other sectors.
Thanks, Peter. I'm just mindful of the time, so I'll just ask you one last question that came through. It's probably a two-tier question. What current opportunities are you seeing in the market at the moment, and perhaps what is your outlook for the rest of the year?
Yeah, I mean, I think it's again 4% return for our strategy versus 4.9 for the market in US dollars. I'm on record saying that when you look at when the fund was launched 7 years ago, we've compounded at about 10.5 in US dollars, 13.5% per annum in sterling terms. Sterling was quite weak over that 7-year period, but I don't want to disappoint any investors. I don't think we can do double digits from here. If our companies remain at the valuations where they are today, and if they do grow their earnings and their free cash flow 7 to 9% per year, I think that's a reasonable starting point. If that means we've already had a couple of percent taken away from this year's returns in the first 3 months of the year, so be it. But I think it's, what I'm excited about is that I know that our companies don't need to get more expensive in order to return 7 to 9% per annum for us. And again, in isolation, doesn't seem that high over the very long term. Those returns are very compelling versus the market, and certainly it's exceptionally compelling versus some other asset classes out there which have significant challenges, without naming any classes specifically. But you know, when you look at bond investors this year, for instance, in US 10-year treasuries, I think they're down about 6%. So already you're seeing a significant shift in the mentality. We want to make sure that we're not momentum investors. We're obviously fundamental investors, owning great businesses where in the long term, those 7 to 9% returns will be driven by company fundamentals, not because we're hoping that the stocks would just get more expensive.
Thanks, Peter. Just one last question that came through, if we have 2 more minutes. Emerging market assets are trading at discounted valuations in comparison to developed markets. Using the high value strategy, which geographies are you looking at and which businesses?
Yes, I can see that question from Wilson. Hi, Wilson. I hope you're doing well. I'm hoping that I could also be back in Kenya sooner rather than later. So yes, I mean, as I said, 30% of our exposure is in emerging markets. When you look at emerging market index, they're actually very, very concentrated now on a few big companies like Tencent, Alibaba, Taiwan Semiconductors, Samsung. So we've owned some of these businesses over time. I've always maintained that, you know, areas, clearly the emerging markets, the index itself is more cyclical in nature, more bank exposure, more industrials, you know, dominate that index. It's become a bit of a dangerous index in the sort of short term because of those big companies like Alibaba and Tencent, as I mentioned, actually driving the index. Now, we would love to get our exposure through the consumer. So when we're buying into Samsung and Alibaba, clearly there are certain themes. We would love to invest in young China when the opportunity comes around. We want to be invested in consumer discretionary names. I've said this quite a few times on record. We don't expect us to buy Chinese banks anytime soon. I don't think that is the sort of company that you can analyze or make an opinion that they actually run for shareholders as opposed to the Chinese government. So we're going to focus on companies that have the growth opportunities like Alibaba in cloud computing, in e-commerce, and as they build out their presence in Southeast Asia, you'll capture that emerging market growth. And then, of course, if Heineken and Diageo can come back to levels where intrinsic value is restored, then clearly those companies, you know, ultimately Diageo's got a big play on India. You want to get exposure to those markets, but it's going to be, and it will continue to be, through consumer-driven demand exposure, not through areas like energy, banks, where business models are obscure and where we can't value those intrinsic values thoughtfully.
Thank you very much, Peter. I think that was a brilliant presentation. We really appreciate your time today. I think we're just going to wrap it up here. But thank you very much. Thank you to all our attendees joining us today, and having you, Peter, present to us and to our counterparties all around Africa. On behalf of the whole Sanlam Private Wealth team here in Mauritius, we want to wish you a very good Easter, and have a good Easter long weekend if you're having a long weekend. And let's speak again very soon.
Thank you very much, Anne. Bye.
Thanks, Peter. Bye, everyone.